You just entered a trade as price broke through that key level, but all of a sudden, price reverses and it hits your stop loss. Ever been there? In today's video, I will explain the difference between a valid and high probability break of structure and price giving you a fake out. After today's video, you won't have this issue anymore. When I started out with trading and I had no knowledge about markets or whatsoever, I would simply identify a swing high or a swing low on the chart, and once price broke above that high or below that low, I would blindly open up a long or short. That's obviously not how it works. And if I did, I would get stopped out every single time.
So basically you became part of the liquidity, correct?
Yes, that's actually correct, Max. This is exactly how smart money engineers liquidity that they can then use to fill their own orders. So they make you think that price breaks above an important high or below an important low, so that you open up a breakout long or breakdown short position or a low probability position. And if you open that position, it means that you always have to place your stop loss above a certain high or below a certain low as well. And they will use that stop loss as liquidity to fill their own bigger buy and sell orders. So in my early days, I was obviously part of that liquidity as well. Now, how can you prevent yourself from being part of that liquidity? By seeing the difference between high probability and valid break of structures and low probability fake out. A break of structure is when price breaks through a significant high or a low before a bullish or bearish reversal. But remember, not every break matters. There's two keys to a high probability break. Price needs to break through a significant high or low, and also price needs to open and close a candle above that high or low in order to get a high probability break of structure. But let's break this down with a chart. Before I dive into a real-time example, on the left, we can see price breaking through an insignificant high, and on the right, we can see price breaking through a significant high. Now, what's the difference right over here? This is where most people are getting wrecked, and this is where most people make profit and get into high probability trades. And the difference is, guys, is that the high over here that we break through carries no significance, and the high over here that we break through carries a lot of significance. Now, how so? Because the high over here is only bringing us to a higher low before it goes towards a higher high, and the high over here brings us to a lower low. And therefore, if a high brings us to a lower low compared to this low that brought us to that high, it carries significance. And if prices only bring us to a higher low compared to the low that brought us to that high, it carries no significance. Now, this is where most people get wrecked, and this is where most people get into high probability setups, because they can recognize the difference between a significant high and an insignificant high. I have found two beautiful examples on INJ in which actually currently one is going real time live, and you guys can actually use it to execute it. But first, let's use the replay for a few months ago. Is this a valid break of structure? Are we breaking through a significant high over here, or are we breaking through an insignificant high over here? Give yourself 2 seconds to think about this. Let's zoom in a little bit more onto the chart and now think about it for a second. Are we breaking through a significant or insignificant high right over here on INJ? Guys, we are breaking through an insignificant high over here. Why? Because we form a low, then we form a lower high, and then we form a higher low before forming a higher high. Now, if this high over here would have brought us to a lower low over here compared to this low that brought us to that high, then we were looking at a valid break of structure because price is breaking through a significant high. Right now, price is simply breaking through an insignificant high, and if you would have longed the reversal based off that confirmation on the daily time frame targeting higher levels, then you can see that eventually you would have been wrecked. Now it's a few months later on INJ, now we can see the price is breaking through another high over here. Once again, ask yourself the question, are we breaking through a significant high over here, or are we breaking through an insignificant high over here? Guys, we are breaking through a significant high over here. How so? Because this high has brought us to a lower low over here compared to this low that brought us to that high. And therefore we are looking at a valid break of structure because price is breaking through a significant high. So if you now want to trade the reversal on INJ, targeting higher levels with your invalidation beneath the low that brought us to that higher high, then you are looking at a high probability setup because you can recognize the difference between price breaking through a significant high And price over here breaking through an insignificant high as well a few months ago. Now check this out. 3 setups on the same pair and only 1 made profit. Why? Wait a second. Many of you guys have been asking me lately where I share all my mentorships, live streams, trade signals, name it. You guys have been asking me, where am I sharing this? I'm sharing this all in Tribe Capital. And I have a surprise for you guys, because you guys can now try out Tribe Capital for 14 days only for just $1. All that you have to do is follow the first link in the description down below, fill out your email address, pay $1, and I'll catch you guys in the tribe. And yes guys, everything inside is so easy that even Max could understand it. But Max, next time, please try not to long resistance again.
There was one time, bro.
Bro, one time too many. The first one only wicked above the significant high. The second one closed above the significant high, but then the next candle closed below again. The third one, which was the profitable one, opened and closed a candle above the significant high that brought us to the lower low before bringing us to a higher high. And therefore, that was a high probability break of structure. And therefore, we made profit.
What time frame do I look at for confirmations?
Well, I would always say the higher the time frame, the more reliable that the data is. And guys, I get it. When you start out with trading, you think that the more trades that you take, the more profit that you'll make. And obviously on a lower time frame, you always have more price action, more moves, more triggers, so you can eventually enter more trades. But trust me when I tell you this, when you start out with trading, whether you're a beginner, advanced, or mediocre trader, you should always stick to the higher time frames first. Because the higher the time frame, the more data a candle contains, the more data a move contains. And you have to realize that the more data you have, the more reliable the statistics always are. So if you use a higher time frame, your win rate will be higher as well. A mentor of mine actually gave me an analogy that changed everything for me.
And what did he say?
He said that before you go outside, let's say you check the weather for a minute and you see that the sun is shining. You decide to put on a t-shirt, right? But then when you go outside, and if you instead would have checked the full weather forecast, you would have known that a storm is coming, that you actually shouldn't have gone outside at all. And the same is with trading. When you just check the 1 minute chart and you don't zoom out and check the bigger picture, you're missing so much data that is so vital for you to be a profitable trader and to execute profitable trades. And I think this is something that so many people fail to grasp, because trading is hard on itself in general. And if you have a higher win rate, which you will have if you stick to the higher time frame, it means that it's a lot easier for you to manage your emotions. If you have a lower win rate, you can still make the same amount of profits over a longer period of time, simply because you enter more trades on a lower time frame with a lower win rate. But it's so much harder to manage your emotions, because you'll take a lot more losses, and emotions become difficult to manage once you take those losses. And guys, trading is hard on itself already. So why in the hell would you make it more complicated for yourself? Alright, so let's wrap this up. Your trade is getting stopped out because you don't know the difference between significant highs and lows and insignificant highs and lows, and you need to mark those out first. We always have to wait for a candle to open and close above a significant high or below a significant low, and you have to stop trading and waiting for lower time frame confirmations and stick to the higher time frame instead. Now, if you like these kind of lessons, make sure to drop a like, drop a follow, so that I can keep educating you guys, so that you don't make the same mistakes that I have made in the past as well. Thank you guys, and ciao ciao!